2012-13. Before we get started, some housekeeping issues. First and foremost, all attendees are muted for the session. So, however, if you want to ask questions, just type them into the question box there. The presentation slides can be downloaded off the Academy's website, and you can type questions in for Aaron today, but dependent upon time will determine whether the questions can be answered. We do have 250 attendees today, which is fantastic from our point of view, so the ability to answer 250 questions, if each one individual had one question, well, it would be very difficult to cover it off in the amount of time. However, all questions that are posited today will be answered in our podcast that will be created and be available online with the Academy's website as of early next week, as will the webinar recording of today's session, together with the top 10 ebook that will be made available to all attendees by follow-up email. One very important issue from our perspective, at the end of the session, there will be a short survey that we would like each of you to complete because at the end of the session we will draw one of the members' names out of or the attendees' names out in respect to the conclusion of the survey, and that person who's drawn out will win a platinum membership to the Academy for $2,200. So it's well worth your time. The other thing we'd also like you to do you'll see there's how many are watching, just me, 2 to 5, 5 to 10 or more. We really appreciate if you could complete that poll as well, please. Now, a very important issue from our perspective is our sponsors. We would really like to thank our sponsors for today. Without our sponsors, we certainly wouldn't have been able to get this session up and running for so many attendees. So I'm closing the poll now, and in respect of attendees viewing, I'll now hand over to my colleague and co-director of the SMSF Academy, Aaron Dunn. Aaron's well known in respect of the SMSF community. He's one of Australia's leading luminaries as far as the SMSF space is concerned, and there's not much about the SMSF space that Aaron doesn't know. Today's session, I think you'll find, will be extremely valuable. Thank you for attending.
Thank you, Ian, and welcome everybody to this year's Top 10 SMSF Strategies. Before we start, we all know, I guess, today's session is general advice, and therefore the presentation in itself we can't rely on, so just be aware of that and please do take that into consideration. All right, so what I'm going to go through today are the things that I see are influencing the self-managed super fund industry for the current year. Now, whether you are providing advice to clients, whether you are administering funds, involved in some way, shape or form, these are the things that I think will be affecting the industry in the coming 12 months. And this may be in respect to things of the 12-13 year, but also may be in respect to those, say, from a compliance perspective, that may be doing 11-12 information for that 12-13 financial year. So we're going to be covering a whole range of things, from contributions through to borrowing arrangements, through to pensions and some estate planning things, and this will just give you an indication of some of the things that I really see influencing the industry moving forward. All right, so the first one here is what I call get out of jail free cards with excess contributions tax. I've just spent, I guess, the last couple of weeks running around the country talking about some of these issues with part of the BGL product roadshow, and it's an amazing number when I ask the question how many people had clients that have been impacted by excess contributions, and I'm sure today there are an enormous amount of people that have also been affected by this. And really, this has first come about was problems that occurred in the 2009-10 financial year, where we had a nearly 300% increase in the number of people that were in receipt of an excess contributions tax notice. Why did that occur in that financial year? Basically because we had this situation where the government in that financial year halved the concessional contribution cap. And that meant that those 50 and over went from 100 to 50,000, and those that were 50 and below 50 went from 50 to 25,000. Now, the problem here is that we're going to arguably see this same problem exist in the 12-13 financial year. This is because we've got the situation where the transitional period, in particular for those 50 and over, has now ceased, and everyone has moved to a flat $25,000 cap. So we've got this problem again where the timing of when contributions are received in the fund and the disconnect to what an employer's obligations are will mean that we are likely to see another spike in the excess contributions from a concessional point of view. But we do now have, I guess, within the legislation, a range of things that we can use or apply to alleviate our client from having to pay excess contributions, whether that is on a concessional basis or on a non-concessional basis. And what these get-out-of-jail-free cards are, and the reason why I do that is because I think many people here are aware or will have played Monopoly at some point, and this was a very handy card when obviously you got sent to jail. So what are these get-out-of-jail-free cards now? Well, predominantly here we've got this now introduction of a once-off refund for excess contributions tax in respect to concessional contributions. So the fact that the Commissioner can disregard amounts of excess concessional contributions and have those reallocated back to the member, and we'll talk about that shortly. We have had for, since the introduction of Simple Super, the ability to return contributions where they are fund capped or the member does not meet the work test requirements. So we can use that and have been able to use it since Simple Super's inception. The third one here is this concept of the de minimis test. And the de minimis test is really an ability where the Commissioner will disregard small amounts that are disproportionate to the liability. And the final one, which really would lead into our second strategy, is this concept of a contribution reserve or holding account, as the ATO and APRA more call it to. So let's have a look at this first one in terms of the one-off refund process. So this is really mapped out diagrammatically how this refund process will apply. So where the individual has lodged their tax return within 12 months after that income year. So in essence, they've predominantly lodged on time. They might be a touch late, but as long as it's lodged within 12 months, we still have an ability to use this refund mechanism. The ATO will determine that we have an excess contribution problem, where those excess concessional contributions are $10,000 or less, and the individual has not previously had an excess concessional contribution problem since 1 July 2011. So anything prior to that, we simply ignore. So for the 11-12 year, that's really the first time that this has been introduced. So where 10,000 or less and it's first time that they've been caught, then they have the ability to receive what's called a notice of offer from the ATO, in which that individual has 28 days to accept that offer. There are certain circumstances where the Commissioner may allow for it to be longer. Where it has been accepted by the member to relocate, the ATO will offer a compulsory release authority, which is not, which is identical, I should say, to the process that is applied with non-concessional contributions that are excessive. Now, we've got a situation here where the excessive amount has already had contributions tax paid on it, and now under this compulsory release authority, the remaining 85% of those excess amounts are paid to the tax office, and the tax office is now the one that holds, in essence, all those funds. And it's an obligation under that compulsory release authority to pay that amount within 30 days. Now, once the ATO has those funds, there is now an obligation on the Commissioner to disregard that amount in respect to the excess contributions, and he will then reassess that money into the individual's taxable income for the year in which those excess amounts were applied. So the ATO on that reassessment must pay out any refund within 60 days of receiving the amount from the fund. Now, because there's already been contributions tax paid on that amount, the Commissioner will allow the individual a 15% tax offset. And upon squaring the ledger from an income tax perspective, they will issue the refund having adjusted from any outstanding debts from a tax position and also from other government agencies as well. So that's really the process and the mechanism how this will be working. Let's just have a look at an example here. So we've got Neil, 53. He earns $100,000 and salary sacrifices up to his concessional cap of $50,000 in the previous year. He's reduced his cap down because he knows his transitional period finished, and he's done it to 25. But what's happened here is because of the timing of his salary sacrifice arrangements, the fund for the year has in essence reported $27,083, which means that his June 12 contribution, which was received in July, was based on his previous higher amount where he was salary sacrificing to the $50,000. So we've got ourselves a problem where the fund has now reported the excess of $2,083. But because this contribution, this excess amount, is $10,000 or less, and is the first time that he's had an excess problem since 1 July 2011, and he's lodged his returns within the prescribed period, the Commissioner will allow for and will offer this notice of offer. And Neil has the ability to either accept or reject that offer. Where Neil ultimately accepts that offer, this excess contribution is disregarded in essence in the fund and becomes part of his assessable income in respect to that 2012 financial year. So there's an amended tax return, as I've already stated. We have this obligation that the fund will have a compulsory release authority for 85% of that contribution. So the fund has already paid contribution tax on that $2,083 amount. It is now obliged to send the $1,770 off to the ATO as well, and we've got the obligations around time frames to get that money actually sent across. The Commissioner will then amend Toby's tax return and include that excess in his assessable income, and will deduct any income tax, Medicare levy. Remember, in the 11-12 year, there's likely to be flood levy as well, and those are deducted, and then ultimately the amount is reissued back to the individual. And that 15% offset, again, is applied because the fund has paid the tax. So that's really how this is going to work. We are going to see a growing number of people that are going to need to use this mechanism, in my view. From memory, the 2012 financial year as well, people that were paid fortnightly, we had 27 fortnights. So just do have a think about and proactively move forward in respect to dealing with this sort of issue with your client. Now, there are a couple of things just to remember also with these excess or the mechanism in respect to refunding excess contributions with our concessionals. $10,000 is a flat number, so it's legislated as such and it will not be indexed. If the individual lodges their personal tax return late, so beyond the 12 months prescribed time within the legislation, the Commissioner is saying that they forfeit their right to have an offer. So we need to ensure that we've got the timeliness of our client's information. Now, where the individual breaches the cap by more than $10,000, there is no refund available. So it's not we get it on the first 10, but we don't get it on the next 2 if they breached it by 12. And not only that, not only do they lose that refund option, but they lose their right to that one-off eligibility. So they no longer have the ability in the future for that once-off refund. So it can be a very detrimental thing if people go beyond that. But there are maybe some ways in which you could mitigate that problem, and we'll talk about that a little bit in strategy 2. If a member has breached in more than 1 year when a contribution, excess contribution assessment is raised, it will only be eligible for the first year. So because we know the timing of when the ATO is ultimately issuing these excess contributions, we could have a situation where more than 1 year occurs where there's liabilities. So you don't get to choose the year in which to work out which tax position or excess position may be better. The Commissioner will apply it to the first year it's identified. It is also an all or nothing approach, so there is no ability to request a partial refund. You've done all the work and you say, well, you know, if we put a bit here and a bit there, that will probably provide us the optimal result. We have a 28-day prescribed period in which to decide whether to accept or reject that offer. And we don't have any ability to, I guess, negotiate with the Commissioner in that regard. And ultimately, when there's not enough capital in the fund to pay it, that amount is ultimately going to be assessed personally to the individual. So that's really it there in respect to the mechanism in terms of that one-off refund, and that will, as I already said, will be something important moving forward with our clients. The second one here is around this concept of returning contributions. So what I'm talking about here is predominantly in respect to our non-concessionals. And what we have within SIS Regulation 704 is that we cannot, the fund trustees cannot accept what are called fund capped contributions. We are not allowed to accept contributions that are greater than the non-concessional cap. Now, for someone who is 65 and over, that is that any single contribution cannot be more than $150,000 in a financial year. For someone less than 65, we're talking about a $450,000 single contribution because we have the ability to bring forward those prior, or bring forward the future year amount. So no single contribution can be more than what those two amounts prescribed there. And if they are, we are not allowed to accept those contributions, and those amounts must ultimately be returned. Now, the most important thing here is to remember that it does not apply against multiple contributions. It is rather where a single contribution is fund capped. So if we look at a situation here with John, where he has made $500,000 worth of contributions, but he's made it in 3 payments throughout the year, we simply have ourselves an excess non-concessional contribution problem because no single amount is greater than 3 times the non-concessional limit being $450,000. So he would just simply have an excess non-concessional contribution of $50,000. However, if it was a $500,000 single payment, then yes, the amount would be fund capped, and there would be an ability, or an obligation, I should say, more to the point, to have that amount actually returned. Now, when we talk about this concept of what is a contribution or a single contribution, we don't necessarily have a clear understanding from the regulator in what this means. And I think ultimately what we might need to do is look to the governing rules of the fund to determine what may be classified as a single contribution. And the perfect example here I could probably give is what happens if we do a series of off-market share transfers into a self-managed super fund. If they're done on the same day, is each one that is made separate contribution, or will they be aggregated as they see contribution themselves? So we're not sure. I guess ultimately what we would need to do is look to the fund's trustees as to how it may actually be aggregated. We also, not only to the extent that we have fund capped contributions, we also know that a super fund is not allowed to accept contributions where the member is ineligible to make them. So also to the extent that someone is 65 and over and has not met that work test, we also have the right and ability to return any amount there. And that may be, again, maybe in the very minor situations, but you may have situations where clients may have triggered excess problems because of non-concessionals made into the fund, but the reality is they have not met a work test, and therefore you do have the right to actually move that back out of the superannuation system. Now, within a self-managed super fund environment though, we rarely would identify within the prescribed period, being 30 days of becoming aware of the breach, that these amounts would be returned. We do have, I guess, two ATO IDs that were issued a few years ago that really outline and state that regardless of the fact that we have a 30-day time limit in which to return these amounts, if the fund does not meet its obligations in respect to returning these amounts, there is still an obligation to return them. So regardless of when the awareness has come about, there is still an obligation to return the excess amount, and that excess amount will not be subject to excess contributions tax. And furthermore, the Commissioner has also outlined in ID 2008-90 that it is only the excess amount that will need to be returned. So in that regard, if we looked at the $500,000 example I was just talking about before, if that single contribution of $500,000 was made, it would only have to be the $50,000 payment that would actually need to be returned, and therefore we wouldn't have ourselves an excess non-concessional contributions tax position. Okay, now we're going to move into this third piece in terms of the get out of jail strategy. So what we've got here is this concept of the de minimis, and the de minimis rule really was raised through the Superannuation Consultative Committee meeting back in March 2012. And a lot of people are probably saying to themselves, what is de minimis? What is the de minimis rule? And what de minimis means in Latin is that de minimis non curat lex, which the law does not care itself about very small matters. And what this means in respect to excess contributions, as stated within the minutes from the ATO, is that the ATO is no longer likely to raise an excess contributions tax liability where there is an inadvertent trigger of the bring forward rule. So a small amount triggers a disproportionate liability. And what we can have here are situations where very small amounts are creating these significant tax liabilities, and the ATO has identified this as a problem within the law, and he's now going back and actually amending excess determinations and basically refunding these amounts on the basis of de minimis. And you may have had clients that have basically applied or have been contacted by the ATO to have these amounts disregarded. If you do have clients in situations, you can apply to the Commissioner on the basis of de minimis, and they will give consideration to that on a case-by-case basis. Let's just have a look at an example here just to outline how this might work. So we've got Jeff, 55, he's self-employed and has made $50,000 of self-employed super contributions to his fund, along with $150K of non-concessionals in that 11-12 year. He's then triggered the bring forward in the 12-13 financial year. When he's completed his 2012 return, he's realised that he can only claim deductions on $49,900, so he can't take himself into a tax loss position, meaning we've now got ourselves a $100 non-concessional contribution. What that means is if we've triggered the bring forward rule in the 11-12 year, not the 12-13 year. And what that has resulted in now is a $70,000 tax bill. So $100 has triggered a $70,000 tax bill. So what the ATO is saying here is they will disregard the $100 amount on the basis of de minimis. So the small amount has triggered a disproportionate liability. And as I've mentioned, the ATO is going back and reviewing examples like this and others in respect to whether these amounts will simply be disregarded and those excess amounts actually returned. So if you have clients in these sort of examples, you will have the right to apply on the basis of de minimis. Importantly, we're not going to see any guidance from the ATO as to what the amount, the measurement amounts might be. So you're going to have to make some judgment calls, and then you're going to have to give consideration to whether you apply for it or not. And then ultimately, these amounts, if they are being returned, will be able to be recontributed into the fund and not being assessed ultimately against the contribution caps in the year in which they're returned back into the fund. All right, now the last piece to, I guess, this get out of jail free is the concept of contributions reserving or these holding accounts. So strategy 2 is contributions and the ability to ultimately defer the timing of allocations, and we're predominantly talking here about June payments. So this concept of a contribution holding account has finally come out, I guess, through the release of ATOID, Interpretive Decision 2012-16, earlier this year. And it's looking at the issue of excess contributions and the timing of when a contribution is allocated for contribution cap purposes. And what this interpretive decision ultimately confirms is that we do have the ability to park contributions for up to 28 days after the month in which that contribution is made. So a contribution that is made in the month of June, there is a right to hold that contribution over and have it allocated to the member up to 28 days after the end of the month, i.e. right through to the 28th of July. Importantly, we have a difference in terms of what the obligation is for income tax purposes versus what we have an obligation for in respect to superannuation law purposes. So for income tax purposes, the taxpayer is entitled to a tax deduction at the time the amount is paid into the fund. From an income tax perspective for the superannuation fund, the super fund is assessed on the contribution that is made in total in the year of the payment. The difference being that the allocation of the contribution for contribution cap purposes under SIS is not applied until the following financial year when we're talking about June payments. Now, the fact that we're holding an amount in reserve or in a holding account, some temporary account, means that the net of tax amount will be held on the balance sheet of the fund for that period of time. Now, the following year, when we actually have to report that amount, because we're only holding the net of tax amount, we have an obligation to gross up that amount by 1.176 and actually include that within the reportable concessional contributions of the following year. The question here is it a reserve or is it a holding account or suspense account? And the ATO, I guess, has now started to provide some more clarity around the fact that they take the view that it is not a reserve, but simply a holding account or some form of temporary suspense account in which to hold the contribution until such a time that is allocated. The ATO are taking the same view in respect to this as APRADU generally, which is through a practice guide SP 235. So what the ATO is saying is it is not typically a reserve in their view because they don't believe there's an obligation when we have a reserve to set up a separate investment strategy to manage the imprudent investment of this account. So you don't necessarily need to have it operating as a reserve because it is not necessary in respect to the ATO's interpretation in that regard. Let's just have a look at an example here to try and show you how this works. And this is not too dissimilar to the example that was included in the ATOID 2012-16. And ultimately, what the ID confirms is the fact that you do have the ability in certain cases to actually double claim a deduction on the concessional contribution cap limit in a particular year. So what we've got here is John 54, and he has an anticipated capital gain of $100,000 in that 11-12 financial year. So we did have for him the $50,000 cap previously. So he's self-employed and he's got no concessional contributions that has been made in respect to that year so far. His obligation is he's got a tax bill. He would like to reduce that bill as far as he possibly can. So what we can do here is we can make $75,000 worth of member deductible contributions into the fund. Now we would need to do this in more than one payment, and I'll come back to the importance of that shortly. But we can claim a tax deduction for $75,000 in respect to the 11-12 year to help reduce that $100,000 net capital gain. From a contributions tax, income tax perspective in the fund will need to pay contributions tax on the entire $75,000 because that is the obligation under what's called Section 295 of the Tax Act. But from an allocation point of view, we will have $50,000 of that amount allocated to John in the 12 year, but we will have $25,000 held off in reserve. Obviously the net tax amount will be held and applied to John in respect to the 12-13 year. Now obviously he's going to need to give consideration for the 12-13 year as to what he is ultimately going to make for that future year in respect to his concessionals, because he's already had his cap ultimately applied. But his objective here was to reduce his CGT bill as far as he possibly could in that year. Now I talked about this issue of we need to make this in a couple of payments. The ATO has come out in recent times and noted two important things here. The first being that we still need to adhere to other elements of superannuation law, and in particular this concept of fund capped amounts, because whilst the ATID talked about concessional contributions here, the discussion on this concept of contributions reserving or holding accounts started around the non-concessional aspect. And ultimately what people have started to give consideration to is to say, well, could we, for example, make a $600,000 in specie business real property contribution, maybe 1.2 if it's mum and dad, with an objective to resolve to allocate 150 before 30 June and then 450 after June but prior to the 28th of July. And what the ATO is saying here is because it's being made as a contribution, that single contribution in its own right would be fund capped, and therefore it would have an obligation to return any excessive amount because the fund is not allowed to accept an amount where someone is under 65 greater than 3 times the non-concessional cap. Also, whether the amount is above or below, we have no ability to split a single contribution. And what the ATO is really looking at here is the intricacies of the wording within SIS Regulation 7082. So it requires the trustee to allocate the contribution or a contribution. So if we looked at the same facts previously in the prior example there, but the business real property was only 400 with an objective to split 150 then 250, the ATO is applying strict wording to say that you cannot split that contribution because that is what that contribution is. So I talked on the previous slide with the $75,000 amount, you would need to make that in 2 payments or more than 2 payments, because if you made it as a single payment, the strict view, according to what the Commissioner is saying here, is you would not be able to split that $75,000 amount. So make sure if you're doing these sorts of things, you are aware of both the fund cap requirements and the ability that a single contribution cannot be split. Okay, let's move into the third one now. We're really going into this concept of limited recourse borrowing arrangements, and in particular, we're looking at the requirements that the Commissioner has come out with in the final ruling, SMSF 2012/1. I've got here the SMSF of the SMSF block. There was about 3 million people that watched this, so I'm assuming there are a couple of people on here that actually watched the block themselves. What we had here is a situation where Channel 9 obviously have bought a very rundown building. This was in Port Melbourne in Victoria this year, and they are basically 4 premises on separate titles. I'm only talking about one of these properties, so let's assume the one with the blue door on the left-hand side. This is what happened at the end of it. There was an enormous amount of money spent on it by the individuals in the contestants in it, and they made an absolute fortune on it this year. My question to you is could we have done one of these with a limited recourse borrowing arrangement? So I'm just going to launch a poll here, and I would be interested to hear whether you think we could structure a limited recourse borrowing arrangement to undertake a renovation like they've done on the block. So we'll just give you a quick second. I'm just going to grab a drink of water and just have a think about it. can we do a limited recourse borrowing arrangement and achieve what the contestants achieved on the block? Okay, I'm going to give just a few more seconds and then I'll close the poll. Okay, I'm going to close it off now. We've got 75, give it 10 more seconds. Okay, I'm going to close it off now and I'm just going to share with you the results. So you can see on the screen here, hopefully, the results have come up. The short answer here is yes, we can. And the reason why we can is because what is the single acquirable asset? What was it that they acquired? What they acquired was residential land and a building. What was it that was ultimately completed? Residential land and building. The important thing that we need to note is within the ruling, the Commissioner is ultimately saying that such a transformation of the property would not have created a different asset. The key thing being here is we cannot use borrowings to undertake the improvements, but we can use the fund's own resources. That's the key difference. We wouldn't be able to do it if the improvements were done using borrowings, but we can do that where the fund uses its own resources. But we can only do it to such an extent that it doesn't become a different asset. What was it that was acquired? It was acquired residential property. What is finished has remained as residential property. So we haven't subdivided, we haven't rezoned, we haven't done any of that sort of stuff. That's why I think this area will be a growing area with a lot of our clients, because they may look to improve things, whether they have an intention to start or down the track with property. They may continue to do this, and you need to understand what the Commissioner's views are here in respect to changing the look and feel of what the property may be. So we can't rezone, we can't subdivide and that sort of stuff, but we can improve an asset to such an extent that it does not become a different asset. As I've mentioned, we can borrow to acquire, repair and maintain. They are the prescribed purposes in which a fund can enter into a limited recourse borrowing arrangement, but we cannot use it for improvement. We can improve, but only to the extent that it does not become a different asset. So how do we determine that? We need to determine ultimately if the character of that asset as a whole has fundamentally changed. So do the alterations and additions to what the Commissioner says is the physical object or the proprietary rights of that comprise what that asset is that was acquired under that limited recourse borrowing arrangement. So in essence what it's saying is you need to give consideration to this on a case-by-case basis. Let's just go through a few examples here just to show you some of the views that the Commissioner has outlined within this final ruling, and whether an asset becomes a different asset and therefore would be in breach of the replacement asset rules contained within Section 67B. So we've got ourselves a vacant block of land. It is then wanting to be subdivided into multiple titles. We cannot do that because it has created a different asset. To the same extent that someone buys a vacant block of land, then they want to add a building on it. The fact is that it's become a different asset. What the single acquirable asset was originally was vacant land. It is now residential property on land. Doesn't mean to say that if a contract to acquire residential house and land as a package does actually meet the requirements of the single acquirable asset definition. But in that example, something where residential land was the acquired asset and it's changed, it becomes a different asset. And where something is demolished and strata titled, for example, the character of that asset has changed along with the underlying proprietary rights, and we've created three different assets and we can't do it. Now the Commissioner here, this is in my view, one of the better rulings that in self-managed super fund context anyway, has come out with. It provides some excellent examples, and this is really where I've got to in respect to this block example that I talked about earlier. These are examples here where we're not creating a different asset. So a house is destroyed by fire and a new superior house, maybe additional level or whatever the case may be. They then decide to put a garage on it or something. The nature and character of what that was and what the single acquirable asset was originally hasn't changed. It was still residential land and building when it was acquired and still is. The addition of a garage, for example, doesn't alter the character of what that asset was. So we can do that sort of stuff. Furthermore, the Commissioner has come out and said any of the following sort of things in itself would not result in a different asset. The extension to add bedrooms, the swimming pool, outdoor entertaining area, garage, additional sheds and so forth. So there is a fair bit of scope here in terms of making significant improvements. It is okay. And further to the extent that he even said you can add granny flat to be constructed in the backyard, which already, there's a property already on it. Regardless of what the granny flat ultimately looks like, 2 bedrooms, family room, kitchen and stuff, the character of the asset would remain residential, remain as residential premises, and therefore is not going to result in a different asset. So it's a very positive ruling that provides some real scope in this area that I think people will continue to look at property in the SMSF space around building some of their retirement savings. Now, we've talked about the fact that you can only improve using the fund's own resources. So there are a range of ways in which this might ultimately occur. So this could be with insurance proceeds, could be with the fund's own money, or there could be any sort of related party or non-related tenant type improvements. Now, when we may have examples where we've got related parties, in particular commercial, where the tenant is also the members of the fund, we do need to give consideration to whether those related tenant improvements may constitute a contribution because we've seen an increment in the value of that property. And we've got to rely there on TR 2010-1, which is really looking from an income tax perspective, what is a contribution. Furthermore, we also need to be aware of the related party acquisition rules. So we're talking about here Section 66, and Section 66 says we cannot acquire assets from related parties, with exceptions of listed shares and business real property and so forth. So what we've got to worry about here, or be concerned with, is are there things that may be being acquired from a member that may not be ordinarily allowed to be done? Example may be with improvements made to the house, where maybe an extension, and the materials in respect to that extension are not insignificant in function or value. And what that ultimately means is if they're not insignificant in functional value, then if they are acquired from the member, then they are a breach of Section 66 because they are not part of the listed exceptions as to be what can ultimately be acquired. So we do need to be aware of some of those things. We may need to have the fund buy those in their own right. That may be impractical, or there may need to be some form of agency agreement or something that sets up some form of maybe bare trust, which the builder has the ability to, on behalf of the fund, acquire those goods and materials and so forth. And the final thing, we also now have, I guess, a new Section 17B into the SIS Act that talks about remuneration of trustees for non-trustee duties. So we do have some strict requirements here we now need to meet to demonstrate that if someone is making these improvements and so forth to an asset of the fund, if they do want to be remunerated for those services, they do need to hold a license, they do need to be suitably qualified, and they do need to be operating a business in building and renovating and stuff to actually qualify to be able to have a fee charged in respect to those non-trustee duties where they are the trustee of the fund. All right, so that really covers the limited recourse borrowing and the improvements area of it. There's obviously a bit more around that concept of, or the requirements in there around single acquirable asset as well, but that's for another day. Strategy 4 now is really saying, well, what happens if we get to a point where the asset is going to become a different asset? How would we look to structure this type of arrangement? And strategy 4 today is talking about borrowing for property development. We do know Section 67A and B impose some significant changes around what is a single acquirable asset and repairs, improvements, maintaining and replacement assets from July 2010. And we have seen through the application of key concepts, the Commissioner has outlined what they ultimately mean through that final ruling. What it clearly outlines is that the ruling says that the fund cannot undertake any sort of capital improvements where it becomes a different asset, which is subdividing and rezoning and some of those sorts of things, and where you've got multiple titles and so forth. We do need to give consideration to the fact that they don't meet single acquirable asset definitions. So what could we have available to us here to address that issue? And what this is really introducing here is this concept of using an ungeared unit trust, so a SIS Regulation 1322C type arrangement, of which the asset of the bare trust or holding trust are the units of the unit trust. So looking through this diagram, we have a lender, you can see up in the top corner, lender to the fund with its existing funds and borrowed funds acquires a collection of identical assets, being those units of the unit trust. And it is those collection of identical assets, being the unit trust units that are held in that holding trust. It is the fund then, or the unit trust I should say, that is the purchaser of the actual property and would be the one that would ultimately undertake that development activity. So let's put this in context and have a look at an example here. Craig and Alana Jones intend to buy a property with sizable land to build 3 townhouses. The existing property and land purchase is $450,000 and the development is going to be just over another $500,000. So we've got ourselves a $1 million project here. The question is they would like to do this inside their fund. Can we ultimately achieve this? And the short answer is yes, we can do it where we introduce this concept of a 1322C arrangement. So let's say within the Jones Family Super Fund, they've got $450,000. We would have, in this case, a related party loan, and I'll explain why shortly. So we have Craig and Alana redrawing, and that may be from their own equity, it may be from a trust or a company or some other arrangement. Anyone that can ordinarily lend money can do this. Craig and Alana, then, being the lenders in this example, enter into an arrangement for the fund to acquire the single acquirable asset. So the fund borrows the money from Craig and Alana. The fact that it's done under a limited recourse borrowing arrangement means that the fund applies for $1 million at $1 ordinary units, and it is those units of the unit trust that are the asset held in that bare trust or holding trust. And the rights in respect to that from the lender are limited only to the units of that unit trust. So we now have our $1 million inside that trust in terms of that Jones Property Trust, and the purchase of the property occurs and the development is ultimately undertaken. We get to a situation here though is we've got some timing issues in respect to the development. So we will have an obligation under the loan to make repayments. So how is the fund going to make the necessary repayments in accordance with the terms and conditions of the loan? And this is where you may need to give consideration as to how you structure that loan document. There has been some stuff come out recently from the ATO talking about whether the interest rate could be as low as 0. And really what the ATO has come out and said here is it is not necessarily the interest rate that is relevant, but it is the nature and relationship of having an agreement in place and an obligation to make the loan repayments, not so much the interest that is being charged. So consideration to the structuring of the loan repayments is important here. Obviously, we need to consider how the cash flow for Craig and Alana is going to come back because they've got obligations to the bank themselves. We end up in a position where we've now got ourselves completed project. We then would ultimately have distributions flowing back through, looking through the bare trust, going back into the fund. Now, because the single acquirable asset was the million ordinary units, we wouldn't have an ability, in my view, to partially sell down on those million units. We don't have any problems, in my view, in making changes to the assets of the trust, but if you wanted to redeem any units, you would need to redeem all of them because that was what was the single acquirable asset. We see the loan repayments and stuff coming through. So one thing here is because the holding trust is only holding units of the unit trust, and the fact that the 1322C arrangement must be ungeared and cannot have a charge over it, we are unlikely to find a bank that will lend. So, because that only security can be taken over the units. So we are really, in my view, here talking about related party loans, and we have seen, I guess, some guidance from the Commissioner through APID 2010-2, which allows for a fund to enter into an arrangement on more favourable terms and still meet the arm's length requirements. And when I was talking about that zero interest rate before, there has been some discussion through the June National Tax Liaison Group where really the Commissioner's come out and said, well, yes, you could have a 0% interest rate because the interest rate, whilst it's a feature, it is more the obligations and so forth to make loan repayments and the nature that it is a loan as such that is more important in terms of the structure of that. And the fact that, that there is a discrepancy between what may be able to be negotiated commercially to that 0% rate doesn't necessarily mean that it would constitute a contribution. When we look at this, we would need to ensure that the money would go in up front. Why? Because that is the single acquirable asset. Because if we wanted to do it further down the track, we would need to enter into an arrangement to set up another bare trust for the acquisition of a collection of further identical assets. We need to also ensure, because of this arrangement, that we meet the requirements of the SIS regulations, and in particular here we've got obligations that we cannot breach within SIS 1322D. So what I'm talking about here is we cannot have a charge over the assets of the trust. It must remain ungeared. It cannot operate a business, etc., etc. So it is a more detailed and complex strategy to use because there are a few other areas that we could quite easily trip up on if we aren't aware of the obligations that are imposed. And the final thing here is well, what happens if we don't have all the money that's needed to finish the project? So it would be very rare, tongue-in-cheek, that our clients would go over budget with these sort of things. So we would need to really look at how we would structure the additional money coming into the fund. If we use further borrowings, we would need to set up a separate bare trust, holding trust, in respect to the acquisition of those further units. We could continue to use the same trustee of the existing holding trust and use that as an umbrella company in that regard, but ultimately we would need a separate bare trust to do that. We could have the super fund in its own right go and acquire further units, so the super fund would hold some of its own name if it had sufficient cash, and some of the others would actually then be still held in the borrowing arrangement. Or finally, you could just have other unit holders come into it. And you've ultimately just got to go down to what's outlined in the unit trust deed that will determine how you deal with those particular subscriptions. All right, strategy 5 here is now dealing with and really moving into pensions. And you'll see a bigger flavour this year in respect to this shift in pensions because we are seeing somewhere around now, statistic I believe, more than 40% of all SMSFs are now paying at least a pension to a member. And also I think to some point the representation of exempt current pension income is going to account for 50% of all assessable income of funds for the 2012-13 year. I'm a big advocate for where possible to be running multiple pensions within self-managed super funds. We do have situations where you only have a single accumulation interest, but structured appropriately you can actually run more than one pension. Why do I think that this is important? Because we can use the proportioning rule to our advantage, and that is to lock in the tax-free and taxable components at the commencement of income streams. Why is this important? Because it gives us greater tax efficiency for pensions where someone is under 60 years of age and it's accessible, or the longer-term estate planning benefits. Now, all of our clients, in my view, fit one of two models, and they are the ski model, that is spending the kids' inheritance, or they want an orderly transfer of their wealth, both for when they're here and for their partner, and then ultimately for their kids. So a large majority of our clients are going to fit into that second category, and structuring pensions this way enables you to achieve some of those results. So before we quickly move on, the final poll for the day I'm going to ask you here is, are you actually running multiple pensions for your clients? So are you trying to achieve multiple pensions, and are you trying to do that for estate planning purposes or building greater tax efficiency? And the reason why we might be doing some of these things is because it allows us the ability to pick and choose where we want to take the money from. And that may be with recontributions, it may be through various other strategies where, for example, we may have unrestricted non-preserved monies with our transition to retirement income streams where there's levels of market volatility or asset segregation. All right, now I might just quickly go to the poll, and there's a couple of people there just having a look. I'm going to give it a close off now, and I'll just share that with you. And the good thing here that I can see is that there is a significant number of people that are actually doing it, which is good, because we ultimately are seeing a strong understanding of the reasons why you would actually do that. So as I said, there are a couple of reasons why I think we should be doing it, and they are around, dealing with unrestricted monies, in particular TTR, volatility and segregation and so forth. Let's have a look at a few examples here. Let's have a look at it where we might have unrestricted money, where someone's wanting to actually start a pension. So the proportioning rule says we must deal with our tax-free and taxable components in proportion to when benefits are taken. If it's accumulation, it's got to be when the lump sum is paid, or proportionately, it's determined on the commencement of the income stream and then done on a per payment basis. SIF, however, does not impose any proportioning approaches or anything to the preservation status of members' superannuation interests. So we can separate our unrestricted non-preserved monies from our preserved and restricted benefits. Why is this important? Because we do have, within SIF, a priority in terms of cashing benefits. If we bundle it with our unrestricted money with our preserved monies, we must first erode any unrestricted benefits. And also, from an allocation point of view, if we're bundling our unrestricted with our preserved money, we must be applying all of our earnings to preserved benefits only. So let's have a look at an example here. Greg's 55, he's got 700 in his fund. He's got 500 of preserved and 200 of unrestricted money. He's wanting to draw $60,000 a year, indexing it, keeping pace with inflation. His access to his capital is an important element to him. It may be that he wants to do a recontribution at 60. He may need income for other purposes, or the capital for some other purposes in the near future. So how do we best structure his pension? Do we commence one, or do we commence more than one pension? Importantly, if we commence two pensions and we separate that unrestricted money, the second pension with that unrestricted money is an account-based pension because it is unrestricted money. So we don't have an imposed maximum on that amount. Let's just have a look at the result here. The green is ultimately what the balance is of the member over that 5-year period. The blue one is what happens if we actually put the money all together. And what you can see here is this is the unrestricted non-preserved monies. Because of the priority of cashing, in essence, all the money that he's taking out every year as pension must first come out of unrestricted non-preserved. And all the earnings of the fund are simply going to preserve. So that is disappearing at a very rapid rate of knots, which is against the objective that he's trying to achieve. However, by splitting it into two pensions and then targeting the minimum out of the unrestricted money and the balance out of the transition to retirement income stream, we are in a situation where within that 5-year period, we have actually grown the unrestricted non-preserved money, because not only are we taking the minimum amount out of that unrestricted, the fund earnings are also being allocated to unrestricted non-preserved. So what it's ultimately doing there is providing a $243,000 improvement over a 5-year period by simply running it as a separate pension. Let's just then also look at it further in respect to multi-pensions, where we would be doing something like a recontribution. So we've got Ted 60, he's recently retired, he's got $1 million balance in his fund, 200,000 of it is tax-free component, so he's got a 80-20 split here. Again, he's looking to take 60,000, keeping pace with inflation, and we've got ourselves a fund earning rate of around 6%. He wishes to undertake a recontribution. We need to take it out in the 80-20 proportion there. What do we do here? Do we commence one or more pensions? Well, this table here will show you, I guess, the implications of both. Where we do a recontribution on the left-hand side with a single pension, we re-weight our components to a 56-44 proportion, and all earnings and benefits must therefore be applied and taken in that 56-44 split. Now, after 10 and 20 years, you can see what the taxable component balance would ultimately be. Conversely, if we separate that recontribution and create a new interest with a 100% tax-free component, as you can see on the right-hand side there, what we end up doing is we can pick and choose which income stream we want to be taking the minimum amount up to the $60,000, i.e. we take the minimum from the 100% tax-free and we take the balance out of the one that only has the 20% tax-free component. All earnings and benefits are obviously applied proportionately, and we choose to take the minimum from only that 100% one. You can see at the bottom there what ultimately happens from a taxable component point of view. It is significantly different by running that multi-pension strategy. And that's what you can see from a diagrammatical point of view, what it would mean between 10 and 25 years. Now, I've only applied there an earning, a particular earning rate and a particular pension level. This is about as good as I could do, folks, so I apologise for what it means, but I'm going to explain to you now what it ultimately means. The bottom horizontal axis is saying, well, what influence does the different level of pension mean? On the vertical axis, what influence does the net earning rate of the fund mean? And the colours here are saying this is the tax benefit in $100,000 blocks. So if we use an example here, after 10 years, someone that was drawing $80,000 of pension at a 7% earning rate, the estate planning benefit is $205,800. Problem is here is that 10 years isn't really an accurate assessment of life expectancy for someone who was around 60 years of age. So the question here is well, maybe we look at something in 20 years. And again, using the same principles of this diagram, we get to a position where after 20 years, we're saying at 80 and 7, there would be no estate planning benefit. So the question is, well, why would we do this? A couple of things to note here. The first is that at some point, and we haven't included it in here, but the member will be entitled to some level of Centrelink entitlement age pension, and that is going to influence the level of income that the member is going to need out of the fund, which will prolong the longevity of their superannuation account balance. The other thing, and the most important thing here is, I think, is even though we get to a point of zero there, the one thing that we don't know with our client is when they're going to die. So whether there's an estate planning benefit or not after 20 years, we don't know whether our client's going to last 20 years. So as a risk mitigation tool, using multiple pensions will at least you can demonstrate to your client that if there is something that happens to them, that the beneficiaries will obtain a benefit from the fact that you've structured your pensions in such a way. All right, we're going to move on now. We're up to strategy 6. So we're looking here at 6 reasons why I believe you should be running reversionary pensions. The first one, and this has really come about since the draft ruling of 2011 D3, and we still don't have any clear indication from Treasury as to when that's going to be finalised, and it continues to go back to the drawing board to be negotiated in some of the issues, in particular around death. The most important thing I think we need to understand is where the pension ceases in respect to death, unless it will cease and go back to accumulation phase unless there is an automatic reversionary beneficiary, or either by virtue of the terms and conditions of the pension or by a definitive binding nomination. So the reason why we would set up a reversionary pension is because we want to get the continuity of the fund's tax exemption for a financial year. If we stop the pension, we do potentially mean that assets that are sold will be subject to tax or partially subject to tax if the fund is ultimately unsegregated for that particular year. The second one is that if we are running multiple pensions like we talked about before, if we don't have a reversionary in place, there may be scope that the benefits of running those multiple pensions become contaminated with the taxable component, because we only have a single superannuation interest when money is in accumulation. So if the pension ceases, does it become a single superannuation interest again, which means all that work that we've done in structuring those pensions basically goes by the wayside. So in my view, running it as a reversionary will mean that we don't prejudice the tax-free and taxable proportions that we've set up with those income streams. We don't have any minimum pro rata pension required prior to death, so we can carry on and make sure we simply meet those obligations prior to the member ultimately passing away. The fourth one, and I think this is really important because you will hear different views in the industry. Some people will say that they believe not to have reversionary because at the time of the death, the member then has the right to pick and choose whether they want to take a lump sum, pension, or something else. Issue, in my view, if you look at 1 and 2, is that you may lose a level of tax exemption, which means some assets may be subject to tax, and you may end up going back to a single interest situation, which means you've got contamination of some of these things. What the legislation, however, states is that you can still take a lump sum and have it treated as a death benefit within 6 months after date of death or 3 months after the grant of probate. So if you reverse a pension automatically and then they decide that they want a lump sum, we can still get it paid out as a tax-free death benefit as long as we do it within the prescribed timeframes. And it may be that we only want to partially do it, or it may be that we want to do one interest rather than the other, or rather than both if we're running multiple pensions. To me, I think that's a critical ingredient, that you still have the right to convert it to a lump sum if you want to, but without prejudicing the fact that we want to get the continuation of the fund's exemption. We also have no change to the minimum for the year, so we just have that continuing obligation to pay it in respect to that financial year. And from a practical sense, the sixth one is that we simply just would have less paperwork. So we would have a written instruction that the pension would continue on, rather than having to restructure and reset up all the income streams at a point in time where people are obviously going through a whole range of difficult things in their own right. So they're the 6 reasons why I think we should be running reversionary pensions. Why reversionary? Because I've already said there, we need to have, in the Commissioner's eyes, definitive instructions that the reversionary is in place within the original pension terms and conditions, or through a valid binding death benefit nomination. It is the ATO's view, not necessarily a broad view in the industry, that a reversionary must be established at the commencement of the pension. There are some in the industry that will argue and will state that they believe that the pension terms and conditions could change throughout the life of the pension. The ATO has established within some notes within the NTLG that they expect that the nomination of the automatic reversionary is stated in those original terms and conditions. Ultimately, it may come down to what the trust deed says in respect to whether that can or can't be achieved. So you need to probably give consideration to the deed that you're using and maybe speak to the solicitor that prepares that deed as to whether they believe you may be able to amend those terms and conditions. However, if you are unclear or uncertain, the most prudent approach would be to undertake a commutation and repurchase and establish that reversionary beneficiary in those terms and conditions. Otherwise, you can try and rely on a valid binding nomination. However, you need to ensure that you meet very strict requirements in the substance and form of that nomination. Strategy 7 now, moving on, and this is really looking at these concepts of segregation versus unsegregated strategies, and in particular the fact that we've got different approaches to how we deal with capital gains and capital losses within a superannuation fund. When we prepare an investment strategy of the fund, the trustees may wish to segregate specific assets or leave the assets of the fund pooled. Segregation can take or can be applied in different forms. So we can, on the bottom left, we can segregate specific assets of the fund. We could also, in the middle, set up pools of members or classes of members ultimately, where the older two, member A and B, may be in pension phase, and the kids, maybe C and D, are in accumulation phase. And so you can set up assets and so forth to manage those pools. The final one on the right-hand side is the ATO says that where member A and B are both drawing pensions and is ultimately 100% in pension phase, it is deemed to be segregated, whether they have specific assets set aside or not. And this is important because it will ultimately determine how we need to deal with things from a capital gains tax point of view. Let's have a look at the example. Fred and Wilma both retired and drawing account-based pensions from their fund. During the 11-12 year, they've realised several investments which have resulted in capital losses of $100,000. Because the fund is entirely paying pensions, the Commissioner states that the fund is segregated. And Section 118(3)(20) of the Income Tax Assessment Act simply states that all gains and losses are simply disregarded. So there is no entitlement to carry forward that amount, even if they had a $100,000 gain. We just simply disregard any gains or any losses. However, if we had a decision to have an accumulation account, whether we rolled it back out of the pension, we had a small amount of the reserve or some other form, but we have $1, as I've used in this example, the methodology in which to apply for tax exemption within the fund, where we have a pooled environment, means that we need to get an actuary certificate using the unsegregated method. What that means is we now need to look at Section 1025 in the Tax Act to determine the net capital gain of the fund. And what that means is that to determine the net capital gain, we give consideration to our indexed and non-indexed and discounted gains and losses. And ultimately, where we have a situation where we have a capital loss, that capital loss is allowed to be carried forward. So importantly, in this example, by having the dollar in accumulation, means that we could carry forward the $100,000 worth of capital losses to be applied in the future. Why is this important? Because the Commissioner has stated, in particular in respect to death, that the pension ceases and then the assets of the fund will ultimately go back to accumulation phase. Also, the Commissioner stated within the ruling that if someone does not meet their pension standard obligations, i.e. meet their minimum pension, the pension has ceased, and at the commencement of the year, and all payments that have been taken out of lump sum, which ultimately means the fund is in accumulation phase. So if you've had gains in that year, you would actually have losses that could be applied against those gains to help reduce some of the tax impact. So just think about how you might want to structure your client's affairs where you've got some gains and losses in a particular year, and take a proactive approach to dealing with that. The 8th one here is this concept of meeting minimum pensions as a lump sum amount. We'll go straight into the example here, because this has come out again of Tax Ruling 2011 D3. And this is looking at the issue of partial commutations and whether the pension ceases and the character and nature of the payment that's being made. Amanda's 59, recently retired, and she's got $1 million in her fund. She wants to commence an account-based pension and withdraw $70,000 for the income year. Now, subject to the level of pension she takes and her other income, you can see here the tax that would be payable in the particular year. If she only had 70,000, 32% rate, $3,297. If it's loading up on money where she's in the 37% rate or the 45% rate, you can see what tax rate would apply, and that also takes into account the 15% pension offset. If the fund is to be taken, if it's to be taken as a lump sum, ordinarily we might go, well, look, we could use the low rate threshold, and this year we've got ourselves a $175,000 low rate cap. Problem is that the fund would be in accumulation phase. If the fund was in accumulation phase, we would have a situation, if we had $50,000 worth of fund income, apply a 5% rate, we would have ourselves about $7,500 tax. We take $70,000 if we do it as an income stream, well, we'd have no tax. So the question is here, subject to the amount of income we take and the tax rate that we pay, are we better doing it as a lump sum but having a level of tax applying the fund? According to my calculations, you would be better to take a pension up to $83,000 of taxable income, including the Medicare levy. So that gives you sort of a rule of thumb that you could work on there. But the question here is could Amanda actually have the best of both worlds? And what this draft ruling is ultimately saying is yes, she can, because the ruling states that where Amanda elects to take a lump sum via a partial commutation, so the election is a key ingredient here, that the income stream benefit will continue to exist. So the pension hasn't ceased. We've only partially elected to take a lump sum amount out. The payment is a super lump sum for income tax purposes and is also a lump sum for superannuation law purposes. So the fact that it's a super lump sum for income tax purposes means that it can be applied against the low rate threshold, $175,000. But it is also a payment for SIS purposes. So, and regardless of whether it's a lump sum or pension payment, it is a payment for SIS, and that all payments paid from an account-based pension count towards the minimum pension obligations for the financial year as a result of that commutation. So we have a situation here where she can literally have those amounts applied against the minimum, get the tax exemption, but have it applied and treated for income tax purposes as a lump sum amount against the low rate threshold. And finally, that amount can be a cash payment, which pension payments can only be paid in cash, or can be an in-specie payment. So as I've just said, you cannot do in-specie pension payments. So this is a way in which in-specie payments could be made out. This is probably going to be something that I see grows more into the future, is this concept of in-species with those over 60. Because we're going to be seeing, as people get older, an obligation to take minimums where they don't necessarily need all the income. So the in-specie partial commutation may give them an opportunity to say, okay, I need to take out $60,000 for my living. I need to take another 30 to meet the minimum pension. Therefore, I'm going to do a partial commutation as an in-specie transfer of 1,000 BHP shares. We are going to see people maybe have to deal with this as an issue in the next little bit, because we are seeing the 25% reduced minimum disappear as of the next financial year. So think about this maybe as a strategy, because people may not want to liquidate assets, so you could use this as an opportunity to simply do that in specie and build the asset back outside of super. All right, the ninth one here, and we've got probably 12 or 13 minutes to go, is strategy 9, optimising pensions within a volatile investment market. And this is really going back to this proportioning rule and stuff that I was talking about before, and really making the most of the strategies that are available to clients with their superannuation components, rather than just simply looking at things at an investment level, and making the most of, I guess, some downward markets and also in times where things are going up. So I've got Arthur, again, we've got $1 million balance here at 30 June. It includes a 50-50 tax-free to taxable component split, but we've had a situation where we've had a very poor share market performance and his balance has dropped to $800,000. Now this isn't too dissimilar to what happened some 12 months ago with many superannuation funds. We've had a very sharp drop in a very short period of time. If we do nothing, the fact that we've got a pension in operation means that the proportions apply and they reduce proportionately, as stated at the commencement of the pension. So we'd end up with a 400-400 split. The question is should we be doing something else for Arthur here? And what we can do here is we may want to consider doing some form of commutation. And it may be that we fully commute the pension because we would have an obligation, or we wouldn't have an obligation to actually reduce the benefits on a proportionate basis, rather the reduced amount would be absorbed entirely against the taxable component. Importantly, just note, if you're doing a full commutation, the commutation shouldn't be occurring on the 1st of July, rather they should be commuting on the 30th of each year. Otherwise, you would need to take a 1/365th minimum prior to it being withdrawn. So what we'll do in this situation is we can simply commence a new income stream, and using the proportioning rule and locking it in at commencement, we have now increased that tax-free proportion to 62.5%. You can then see here just in the table what that would ultimately mean. That 12.5% improvement is important because if Arthur was under 60, it would mean that his taxable income has been reduced. If he's 60 or over, all you're doing here is you're improving the longer term benefit when any money is ultimately paid out to non-dependents. But the fact that we're going back to accumulation phase will mean that we've got an opportunity cost. So in this example, we're saying 2/12 of the year, the fund is going to be in accumulation. If we had 4% income, we'd be saying it would be $6,500 worth of assessable income of the fund, 15% $1,000 tax. Now, in Arthur's case here, if he was taking a $50,000 pension, there would be no benefit in him really doing it because only $25,000 of it would be assessable pension, which means he'd have no tax. So the fact that we're creating a $1,000 tax bill within the fund, as you can see there, means that the position would be worse off. So no real benefit there. However, at an estate planning level, you can see here in the table what that means after 20 years. So the account balance we've still got, the second row there, $314 versus $235,000. And you can then see there in respect to what the dollar benefit means if it was paid out directly to the children of that deceased member. So there is definitely an improvement that can be made, and that is really just in a single year. And that could be applied on an ongoing basis. And that's why I'm a big believer. You really need to make sure you're distinguishing between what you may be providing from a planning perspective in investment advice versus the ongoing strategic advice of the fund. Okay, final one, folks. Strategy 10 is the issue of whether we look at applying anti-detriment to our clients, we look at doing recontributions, or whether we actually do both. Anti-detriment here is really come to the fore because of the Commissioner's views highlighted in the tax ruling when a pension commences and ceases. Not only do we have to deal with the lump sum death benefits where we're paid to non-tax dependents on the taxable component, but we've also got to deal with capital gains tax within the fund because where the pension ceases, the Commissioner is saying that the fund goes back to accumulation phase. When we look at recontribution, we are typically looking at this 60 to 64 window where we could, in essence, potentially get the money out tax-free and get it in using the bring forward. It can extend beyond 65 where certain work tests are ultimately met. Let's just have a look at an example here. So John, 62, is retired and is the sole remaining member of his fund. He's got $450,000 made up entirely of taxable components. He's got 2 adult kids remaining, and he wants to ensure that they get their amounts equally. The question here is should John do a recontribution strategy or should he look to fund an anti-detriment payment? If we do a recontribution, $450,000, we can get this done in a single payment. And what it's ultimately going to do is save us $74,000 in lump sum tax when this money ultimately passes through to the children. But what about in the fund if we've got $200,000 of unrealised capital gains? The fact that we've now got ourselves entirely tax-free component means that we have no scope to do an anti-detriment payment, because the way anti-detriment or the tax-saving amount is calculated, it is based on the taxable component, because it is a clawback in respect to concessional contributions and the tax that was introduced back in July 1988. So here's an analysis. What you can see on the right-hand side is the recontribution. We get to a net benefit down the bottom where the fund will have paid $20,000 in CGT and $430,000 ultimately pays out. We get to a similar figure when we run an anti-detriment strategy, but there are two things that we need to be aware of. The first is that the anti-detriment payment must be funded in some way, shape or form. You cannot forfeit a member's benefit to pay an anti-detriment payment. Therefore, you need to either build reserves of the fund, have insurance proceeds, or potentially have unallocated fund earnings that can be applied to fund that payment, because you can see the ultimate death benefit paid out in the middle there is $513,000. The other thing is that if we are using reserves to fund that, we may end up, or are likely to end up, in an excess contributions tax position, in particular where we've only got a $25,000 cap, because it is the Commissioner's view that any allocations from reserves, unless done fair and reasonably and within 5% of the value of the member's interest at the time it is credited, then it will count as a concessional contribution. So the net benefit, whilst it looks equal there, we do have some practical considerations that we need to consider. Other thing that we need to raise with anti-detriment is that it creates an enormous tax liability, which may be fantastic here, but it's clearing out $200,000 worth of gains, but we've got an enormous carry-forward loss. This becomes a future benefit, which is where people talk about this intergenerational change within funds. But are the kids going to use it? One may use it, one might not. Is that a fair outcome? So the question here is there an optimal outcome that we can start to look at and work with our clients to try and structure this appropriately? And what I've now done on this final table here is on the right-hand side, is we've now got ourselves a combination of both. So what we do is we need to fund an anti-detriment payment to clear the current $200,000 liability. So we've got ourselves $30,000 there. And what that means is that we have available to do a recontribution on $238, just under, $1,000. Now that means we need to fund $30,000. Even if we use reserves of the fund, we haven't got a significant excess problem. We may be able to use it through unallocated earnings and stuff as well, so that we don't even breach that as an issue. We get out $237,000, no worries, tax-free. We've got it on the taxable component there, but you can see we've actually got ourselves a better result again than simply doing it by a recontribution. And ultimately that means that only 2.21% tax will apply on all income and the death benefit within the fund. And that there, in my view, is the power as to why you should be looking to those things concurrently rather than just one in isolation to the other. Anti-detriment will play a very powerful role where you've got lumpy assets such as business real property, and in particular if that asset is to be passed out to a particular beneficiary where they may be running the family business or something as well. So that's it, folks, really. So my top 10 strategies for the year. Make sure you're using your get out of free jail cards for your clients to deal with excess contributions. Use your contribution holding accounts not only to manage excess contributions, but in some cases you may have the ability to double dip on a tax deduction within a financial year. Think about how your clients may be looking to do property improvements using borrowing arrangements. The block example there provides you with one really powerful example as to what you can now do with LRBAs. You can also extend it to the use of 1322C trusts if they are creating a different asset, but be aware of the issues that come with that. Almost always run multi-pensions. I was glad to see with the statistics that a lot of people are doing that. Ensure that you're doing it and think about the ways in which you would ultimately run it. ensure that you're using your reversionary pensions and understand the reasons why they should be automatically reverting rather than simply having it as non-reversionary. Think about the methodology that you're going to be using with your clients in years where the investment strategy of the fund is creating some capital losses. Take and think about how you're going to structure pension payments in a particular year, whether the amounts are accessible and they've got unrestricted monies and they could potentially take it as a lump sum, or longer term if they need to take minimums and they don't necessarily have the liquidity to do that. Again, you can use that strategy to take those lump sum amounts out. Make sure you are really separating your investment and your strategic advice, and take advantage of how the proportioning rule works in times of volatile markets. There is some both upside and downside to markets that you can take advantage of there. And finally, our anti-detriment strategy, do you run that? Do you run your recontribution? Or I think I've hopefully showed you that you should be actually considering both in certain circumstances. That's really it for me there. We do have, we are just finishing off at the moment. The publication in terms of our ebook is just literally getting put together so that it will be available online. We will be making the ebook, the recording of today's session, and the podcast of our questions today. So we do have a whole range of questions in here that we are going to convert into a podcast on a strategy by strategy, so you can know where you need to go in respect to your question. They will be available, and we will send an email out to everyone with access to all three of those early next week. That is really it today. I'm going to hand over back to Ian, but do feel free to inquire with us in respect of the benefits of becoming a member of the Academy or some of our regular training, our online SMSF Word Fusion suite that we now have. But other than that, I'd like to thank everyone for your time today. It's been a pleasure. I hope you've got a lot out of it, and I wish you a good afternoon.
Well, thank you, Aaron, for what is more than a luminary assessment of the 10 most valuable strategies for the current financial year. I would just draw your attention to the opportunity of becoming a member of the Academy. We're asking you to complete a poll at the end of today's session, and we will draw one lucky attendee of today's session out of those who conducted the poll, and they'll become a platinum member of the SMSF Academy. We look forward to you joining us in respect of future webinars that run on a regular basis. We encourage you to go to our site www.thesmsfacademy.com.au and have a look at the services that are available. We're certainly keen to have you give us some form of indication as to whether you would like to be a member of a workshop in October, which would be a one-day session covering off what you've heard today, together with other information. Again, thank you very much for the sponsors and for your attendance today. Good luck in the SMSF industry.